In focus as traders speculate about just how much the crude prices will fall. Crude prices, remember, tumbled by another 3% earlier today, hitting fresh 12-year lows. Prices have been driven down by concerns over, of course, the weakness in the global economy, which is fueling the oversupply glut. Brent crude hit a low of about $30.4 per barrel in early trade before struggling back into the green, marking a fall in prices of 70% since July 2014. In fact, analysts are now slashing their 2016 forecast, and suddenly it seems Goldman Sachs' forecast of $20 a barrel may not be that alarmist, especially after Standard Chartered 2 overnight took a super bearish view, suggesting prices could drop to as low as $10 per barrel. In a research note, the bank said, and I quote, "Prices are being moved almost entirely by financial flows caused by fluctuation in other asset prices, including the US dollars and equity markets," unquote. Well, so has crude neared a bottom, or is there further downside left? To answer that and more and examine the factors that will influence prices going forward, I'm now delighted to be joined by Richard Mallison, the geopolitical analyst at Energy Aspects in London. Thanks very much, Richard, for joining us here on CNBC TV 18. The last time you were there on our channel, you had said last month in December, in fact, you had said that oil could hit the lower end of $30 in January. That's what's happening right now. But the question is, how much more can it fall from these current levels?
Well, I think at the moment we're seeing very strong influence of the fallout of the Chinese stock market sell-offs and wider concerns about the macroeconomy. And because that's not about oil market fundamentals, but it's about the external factors, also the appreciation of the US dollar, I think it can push oil prices even lower. There's definitely negative sentiment. We could see oil go below 30. But I don't think fundamentals have worsened dramatically over the last 2 weeks compared to where we were just before the new year.
Because you know, the last time when you were there speaking with us, at that point you had said that oil prices falling to about the $20 per barrel, which is what Goldman Sachs has predicted, was reasonably low. But then, you know, just some time back, Standard Chartered also came out with a report suggesting $10 a barrel. So do you feel, you know, that sort of precipitous fall is expected, or do you think now oil is sort of reaching a low from where, you know, the only way to sort of move would be to move up and go north, the prices?
Well, I think the bias in the market is still negative, so prices can go down. We can probably break that $30 benchmark. But the point is that there isn't that much in the way of fundamentals developments really driving oil lower, and certainly not keeping it lower. So I think any moves downwards are likely to be quite short-lived. And I still believe that later this year, we should see a correction as supply begins to respond to lower prices, and because demand globally continues to grow. So the lower we go now, the bigger that rebound later in the year, towards the end of the year, will have to be.
Right, but how likely will that be, Richard, considering the fact that there's very little consensus right now between the OPEC countries? So what makes you, I mean, you know, what's your prediction based on when it comes to some sort of a turnaround in oil prices?
You're absolutely right. When we look at OPEC, I think there's very little chance of the group agreeing collectively to cut production anytime this year. Instead, the issue is that the low prices mean they are simply slashing their spending. So countries like Angola, Nigeria, Algeria, all of the OPEC members really are going to struggle to maintain the investment levels to even keep production flat. So Iran, when sanctions relief takes effect, will be able to bring more oil onto the market, but I think other producers within OPEC will struggle, and so OPEC production as a whole won't grow strongly. Meanwhile, non-OPEC supplies will fall, led by the US, where shale production is declining already, and I think demand will continue to grow, perhaps not as strongly as 2015, but enough to help us rebalance the market in the second half of the year.
Right, but what would be the long-term implications, really? That's what many people are asking, long-term implications on economic growth and the global recovery. What do you think? I mean, if prices remain at this level, I mean, what can be, you know, what can be the implications of this?
Well, if we were to enter stable low prices, it would be a big benefit for any net importing economies. So India would certainly be one, even the US, lots of parts of the world would benefit. But I think sadly the reality is that we aren't going to see prices stabilise at these levels. It's simply too low to cover the production costs for high-cost non-OPEC supply regions. And so instead we're likely to see volatility, just as we have over the last year, continuing for the next couple of years. And that's not good news for the global economy, because periods of low prices, good news for consumers, but big increases in prices, big swings in prices aren't good news for consumers or producers.
Right. Richard, if we were to break down some of the key reasons because of which, oil prices have indeed fallen at this level, clearly oversupply is one, the slowdown in the Chinese economy is the other, and many are also now saying that because of the US interest rate hike and its impact on the US dollar because of the appreciation, that is also having an impact on sort of pulling down the prices. But if you were to analyze these three factors more closely, which one of those factors would you say is perhaps most responsible for the decline in prices?
Well, I think when we look at the whole of the decline, so from summer of 2014 when prices were above 100, the biggest, most persistent factor has been the global oversupply. That really began with US shale production, but it also was other regions of non-OPEC, so Brazil, Canada, lots of countries adding more supply into a market that really didn't need it. And then over 2015, a lot of that oversupply came from within OPEC. So Saudi Arabia and Iraq together added, getting on for 1 million barrels a day of additional production year on year. And that's a huge amount for a market that was already oversupplied to absorb. So yes, the appreciation of the dollar has had a factor. Yes, concerns about global economic growth have played a part, particularly in recent weeks. But the big factor here is the oversupply, the fundamental oversupply in the market, and that's what needs to be worked off before prices can rebound.
Right. My final question then, Richard, would be the fact that, of course, the big development today is also, BP going ahead and announcing that they will be cutting 4,000 jobs because these prices are just not sustainable. The last time at the backdrop of the Asian financial crisis, when oil prices had fallen to, in fact, as low as $10 a barrel, that led to major consolidation in the sector. Do you see that, a possibility of that, with oil prices hovering this low?
Well, I think we're definitely seeing a lot of pain across the oil-producing companies, but also the oil-producing countries. And I think that's pushing very difficult decisions, be it major job losses and slashing of capital expenditure for companies, or even subsidy reforms and big budget cuts for countries. The options are certainly, I think, all on the table in terms of how do you continue to respond. I'm not sure we see the same kind of consolidation as in the late 1990s within the industry, but I certainly think for those companies that are less well prepared, this is an incredibly difficult period.
Right. Thanks very much, Richard. We're going to leave it at that. This is going to be a story that we'll keep revisiting. Thanks very much for joining us live from London here on The Big Picture.